What if I told you there was a simple way to plan for inheritance tax that often is probably cheaper and easier than most other options, despite the fact it often gets overlooked? So many people, I think, are thinking about inheritance tax in so much more depth now, especially now that the budget announced from 2027, most pensions will be inside the estate. And since the budget, I've been getting questions from clients on inheritance tax. Some even asking, is it worth saving a certain amount anymore into my pension? Well, in this video, I'm going to give you the unvarnished truth on your options, including one easy to find document which is painfully underused, which could save your family tens of thousands in inheritance tax. It's something simpler, and amazingly 6,000 estates made a mistake on this, and the projected cost of it was 280 million. If you don't know me, my name's George Agan. I'm a chartered financial planner. I help people retire without worry. And today I'm going to show you the easiest and often cheapest technique that can protect your family from an unexpected inheritance tax bill, which also allows you to maintain lovely control of your assets. Sounds too good to be true, right? Well, I'm going to give you 3 different client examples and 3 different strategies so you can think about it yourself. And the first thing I want to do is just to really understand the position around inheritance tax. I've done a full deep dive in other videos that you can watch with a full explanation of the rules. So this is just going to be super high level. As a recap, each individual has a nil rate band of 325,000 before inheritance tax applies. If you leave your home to direct descendants, there's potentially an additional main residence nil rate band of 175,000. And if you're married or in a civil partnership, you can actually potentially double up on second death, which means there's potentially 1 million inheritance tax free bands. Anything above that is charged at an inheritance tax rate of 40%. There is a spousal exemption that applies. So assets typically are only chargeable for inheritance tax on second death if it gets left to the spouse. There's also gifts you can consider. Most gifts are outside the estate after 7 years, as long as you survive that long after the gift. But also just be wary that if your estate is above £2 million, then that main residence nil rate band starts to get tapered away. The insight here is that if you have a reasonable amount of assets, gifting either now or in the future might be a really key strategy. So I just want to go on a bit of a journey on the options and what we're trying to achieve with any planning so that we can work with the end in mind and be honest with ourselves. We need to understand first, how important is it to you? Any proper planning has some form of trade-off. So the first thing I would ask of you is, how much do you care? What I can tell you from experience advising, it's a personal decision. I have some clients who go through the calculations and it's a case of, okay, it's my beneficiary's problem. They've always been looked after and they're going to be now. And frankly, they're going to get a good amount anyway if I pass away. And others have a real visceral dislike for paying any inheritance tax and are willing to make the trade-off so that they know the government doesn't get anything additional. Okay, so let's say that you do care and we've got past that hurdle. This is one we need to consider, and I've created a little table. It's far from perfect, but it just gives you a bit of a guide to decision making. On the x-axis, we've got how much control you need, starting with I need to keep all the money, I'm happy to give, and then I'm happy to give, but I need control over when it's received. And that might be because maybe the age of the beneficiary or maybe other reasons like protecting what you give against divorce in the future. Anyway, on the y-axis, we have the trade-off, which goes from not willing to pay anything, and that kind of refers to things like life insurance premiums, then willing to pay something, and also willing to increase risk, because there are some tax-efficient options where if you are willing to take more risk, they can be worth considering. These titles are really broad guides because there's real nuance here. So as you can see on one of the boxes where it says I need to keep the money and I'm not willing to pay anything, I put in kind of a tongue-in-cheek way, get real, because at the end of the day, there is some sort of trade-off. But we've got other things like loan trusts, which are trusts where you can loan money, but actually that can be an effective tax-efficient strategy. You've got using your current bands. If you're not willing to do anything, then okay, you're kind of left back to the bands, aren't you? Then we've got happy to give, but not willing to pay premiums, or we can use gifting, exemptions, and some trusts, even though that's a bit of a misnomer because trusts do have a cost. There might not be a cost as implicit as a premium. And then you've got another option like I need to keep the money, but willing to pay something. So that's life assurance, assuming in good health. And you can see other options as we go up to willing to increase risk, includes things like enterprise investment schemes, business reliefs, maybe even contributing to the kids' pensions or other investments. So that's a guide of things we can discuss in other videos. But in this video, I want to really focus about people who care about inheritance tax, who want to ensure that their entire estate ideally is left to the kids, understand there is no perfect solution on the trade-offs. But here's the crucial thing. They can't really afford to give away all their assets right now, and that's key. So the first example I've got is property rich Sam, who is feeling pretty aggrieved by the budget. Sam is 70, he's divorced, he's in good health, and he's got 2 adult kids. His main residence is conveniently worth 500, which is in line with the nil rate band and the main residence nil rate band. But he's also got a buy-to-let worth 250,000, and that's in his own name. And that brings in about 15 grand a year. The thing is, he bought it ages ago for 100,000. And if he sold it, he'd get hit for that in capital gains tax, the 150 grand or so. He's in a good position with his pensions. He's got a defined benefit income, which alongside his state pension meets almost all, but not everything as far as his needs. You know, his buy-to-let income originally provided some much needed income in early retirement where he was spending a bit more. But now he's starting to settle down and he's 70. He's having more money coming in than going out, which is a great problem to have. He does still need some of the income, but probably only about half before tax or about 6 grand after basic rate is applied. Sam also would quite like to give the property to his kids. You know, he's always been a big believer in property. It's been a decent earner in a good location, well tenanted. And he knows that if he was to give that to them, it would give them a nice income in the upcoming decades. So based on all of this, the excess income, but also the strong desire to make sure the estate is reduced, what we do firstly is we work out the inheritance tax position for Sam if he died today, which is £100,000. Now, the thing just to point out is that the kids, if he dies, probably would sell his main residence. They're not really going to live in it, are they? They could just go, well, we'll just use that to pay the proceeds of the inheritance tax bill, which is a completely viable route. But is it worth considering the other options if Sam wanted to keep as much of the estate as possible? So Sam's 70, which based on ONS life expectancies means his average life expectancy is 86. With a 25% chance he'll reach 92 and a 1 in 10 chance he'll reach 96. Of course, no one's got a crystal ball here, but it's important to consider the probabilities when planning. We also need to bear in mind that inheritance tax is a moving target, so the assumptions I'm going to make in this example are inheritance tax bands don't increase with inflation. I think they will eventually, but it probably makes sense to play safe. So then if they do, it'll be a surprise to the upside. This could maybe be a point of discussion with Sam because it does require some assumptions. I'm also going to assume that £100,000 liability will increase with inflation. What I would actually typically do in this instance is have a look at the nominal increases in properties over that area in a period of time and track to that. There's no perfect answer here on the assumptions you make, but they should be reasoned and reasonable if possible. So the first thing we could do is consider a simple insurance policy called whole of life policy, so that when Sam eventually passes away, that this will cover the £100,000 inheritance tax bill. The whole of life policy is written with guaranteed premiums. Now that means that the premiums are guaranteed not to change over the policy length, and it pays out if you die. So all you need to do is continue to pay the premiums and it will pay out. The payout ratio for policies like this is 99.9% for obvious reasons. The policies are almost always underwritten where the insurer assesses the health position carefully, typically writes to your GP for medical information. This is a good thing, I believe, because it actually means you've got full transparency on both sides. So at time of recording, assuming he's in good health, the cost of this is about £225 per month. Now the rates are going to be heavily impacted by age, health, and so forth. So this is only a very rough guide. Now, I feel it would be almost wrong with any of this stuff to not mention that the elephant in the room is unexpected costs or care. This is a huge problem with retirement planning that no one has a simple answer to. Some people impacted hugely, some people aren't. The average care home cost is 54 grand a year for a single room and up to 74 grand in London. Just for some context, apparently Eton costs 52 grand a year. So it's kind of like maybe or maybe not potentially having to fund going to Eton at the end of your life. If it's not long-term care, we should think also about things like home adaptations. They can easily cost 50 grand, like a stair lift can cost up to 7 grand, a wet room 15, wider doorways 5 grand, again, depending on your location and the work that's required. Now, remember that document I talked about earlier? That's about writing the policy in trust. Shockingly, 6,000 estates made a mistake, which apparently cost a projected 280 million where it didn't need to. Now, why would you write a life insurance policy in trust? Well, a trust very simply is a legal arrangement which allows you to separate the assets from your own. The key reason it's so important to do so is if you don't write the policy into trust, then the proceeds of the life insurance actually go into your estate. And if inheritance tax is payable, it could mean that whatever's paid out gets a 40% haircut from HMRC. Now, a simple trust document, which most insurers offer without charge, can ensure the entire amount stays outside of your estate and also avoids probate, which can take many, many months to go through. So if you do happen to have life insurance and it's not written in trust, maybe check it. So you might be thinking, oh, 225 quid a month, that's pretty steep. All right, well, what happens if, forget the £225 per month, what if Sam were to give that £6,000 per year extra just to his kids immediately? And actually that might fall in the normal expenditure out of income rule. Well, assuming Sam lives to 75, 86 and 92 and gets a 6% nominal return, the position would be 75, 33 grand, give or take, 86, 156 grand, or 92, 265 grand. So very simply, yes, he could just give that money for the kids to invest and maybe pay a bill. And I wanted to kind of flag that, but obviously investment returns aren't guaranteed. And as you can see, the position does change substantially depending on how long he lives. Insurers are taking the risk that you could die immediately and they get next to no premiums, but you take that risk if you live longer into retirement. You could have, in hindsight, chosen a better option. It's the cost of the certainty that you're paying on the life insurance. So that's one option, albeit a slightly imperfect one, when you want a certain outcome and perhaps gifting isn't going to be effective. For me, personally, I do on occasion, but quite rarely advise on whole of life policies just because of that moving target aspect. And sometimes they're just better options. But what happens if you have assets you can gift, but you need to act now to gift? What might be able to do which is a bit cheaper? Well, let's just dive into that 7-year rule. An outright gift of, say, cash takes 7 years until it's outside of your estate entirely. There is a problem though. If you die within the 7 years, it comes back into the estate as if it's not been gifted. There's an option here where maybe a large gift is required, so exemptions aren't possible. And it's quite likely someone will statistically survive 7 years, but you want that certainty so that you know that the gift is going to go to them. So let's say you've got Sarah, and Sarah is 78. She's widowed and she's inherited her husband's nil rate bands and a defined benefit pension. So she's got a decent amount and there's potentially £1 million to leave to her only daughter, Claire. The house is worth 700 grand and she doesn't want to downsize or move. She does kind of accept that they'd sell it if she went to care though. She has enough pension income from her state pension and the widow's defined benefit scheme. There is an issue though with her assets when we look at it from the lens of inheritance tax. She's got cash of 200 grand and an ISA worth 300 grand. So that's 1,200,000 or 80 grand inheritance tax if she died immediately. For the technical nerds out there, don't you dare mention quick succession relief. We're not going to talk about that. But the thing that's also notable is that if the stocks and shares ISA grows, the worse the problem would get. Now that's a bit of a nonsense because, having more money and then having more tax on it isn't really a problem. But I'm just saying in the lens of inheritance tax planning, it is. So based on those criteria, it's clear that Sarah could maybe just give the cash to her daughter. You can't transfer ISA wrappers, sadly, so I would probably suggest typically she keeps the wrapper even if she does revert some of the stocks and shares to cash. So she's going to give that 200 grand gift, and Sarah hasn't used her annual exemption. So that means she's got £3,000 each year, and she could also use the previous years because it was unused, so that's £6,000. So now it's just £194,000 of the gift that she could potentially look to insure. But she doesn't need to insure the full 194,000. That's the amount that's chargeable to inheritance tax. It's 40% of that, or 77,600. Remember, the purpose of this is to clear the inheritance tax bill if she's unfortunate to die within 7 years. And again, a conversation does need to be had on property growth and other assets, but let's just stick with these assumptions. So what Sarah could do is just put in a level term assurance policy to cover the inheritance tax liability. Now at time of recording, assuming she's in good health, that would cost about £165 per month, which means that if she paid the premiums for the full 7 years, she would have paid £13,860. And in doing so, she saved £77,600 of inheritance tax if she died within the 7 years. If she died after the 7 years, she's not actually saved anything because she could have just used the 7-year window. Just very quickly, to kick off the new year, I'm running a Beat the Budget Retirement Masterclass. It's live on 30th of January. So if you're worried about how recent tax changes could impact your retirement planning, you will need to join the masterclass. We're kind of pulling the curtain back on some strategies which help our clients save thousands in unnecessary taxes. You'll get to discover step-by-step processes from pre-retirement, drawdown and legacy strategies and how these new pension inheritance tax rules will affect planning. There's also quite a bit on hidden risks we see with investment planning in 2025, and I'll be joined by our CEO at Flying Colours, Guy Miles, who co-founded Octopus Investments, and he'll be talking about the framework we're using to help our clients retire with confidence. So all you need to do is click on the QR code or the link below to reserve a spot. And the purpose of this is to just kind of use it alongside gifting or exemptions. All right, my final example is an interesting one, and especially from 2027. So let's assume today it's 2027, it's after the tax year, and pensions are now in the estate. We've got David and Helen, who are 60. They have $1 million in property, and they've also got $1 million in pension assets. I know, lucky them. They've got no other retirement income sources apart from the state pensions, which are full. Now, the thing is like for many individuals, pension assets are split unevenly. So there's $750,000 in a pension asset for one partner and $250,000 for another. And one of their concerns is that now pensions are inside the estate, while they will be spending down on the pension, if the pension does grow above its current value or they both pass away early, they'll get hammered for inheritance tax. Also, if they do get investment growth, as we expect, they're now going to be above the £2 million estate value. So their main residence nil rate band will get tapered away, making the inheritance tax position worse. We would, however, expect them to spend down the pensions in retirement, so a view should be taken. So in this instance, what they could do, which could not only mitigate the inheritance tax, but also create some parity and maybe some security, is consider using the larger pension pot to secure some guaranteed income. So after reviewing the expenditure, they thought, well, actually, do you know what, for a bit of sleep at night factor, we want to know that whatever happens to either of us, the household will have 22 grand in secure income. That's kind of our keep the lights on amount. And so let's say, to keep the math simple, that they go, okay, we want to make sure that's there for later retirement. So now I'm not going to dive into fixed term annuities to bridge the gap for state pensions. I'm just going to assume this 22 grand is a later retirement requirement. But let's say that they use then their pot to purchase a guaranteed index-linked RPI, which is the higher inflation level, joint life annuity. So what that means is it's guaranteed for life. It pays out full, regardless of who passes away first. And also it's linked to a high level of inflation, which is RPI, retail price index. Now, assuming they're in good health, at time of recording, the annuity rates for this is 3.7, which means to get the £10,000 income, it would cost you $270,270. You also have to typically make some allowances for tax, but I'm going to leave this really simple at this stage. And I think just want to pause there because 3.7 doesn't sound great, but do bear in mind that people talk about using the 4% rule for drawdowns as a guide, which is inflation linked, but that doesn't factor in things like investment costs. So you could make the case that if you're going to use a little bit to secure some guaranteed income for you and your spouse, which means that whatever happens, you've got that security, then depending on your views on risk and how you feel about the markets, it can be worth considering. The other benefit in the new world from 2027, though, is this reduces the value of the estate by the 270,000 because you're converting the lump sum into income. They clearly lose out on the upside if the investments grow, which I very much expect they would. But their estate is also worth less. So you could make the case that there's 108,000 of inheritance tax that they potentially wiped. They've also mitigated the fact that their estate's unlikely to go above 2 million for a while. Another thing they could consider is they could go, all right, well, why don't we consider also in addition to this, maybe securing a bit more income and putting in a life insurance policy over that interim period. So maybe using that alongside a decreasing term policy. So you've got the guarantee of the annuity, but also you've got some life insurance to cover you if you die early. And then you use that and some gifting strategies to eventually kind of steer the ship so that you're using your time to, reduce the value of the estate as your retirement develops. Now, I have to be really clear here because I'm not sure whether many people know this, but there's actually legislation from HMRC called back-to-back arrangements. Now, I'm going to put some details on the screen, but just to explain, we have to be careful when taking out annuity and life insurance because HMRC's view is that what they don't want is they don't want somebody who's in particularly bad health, maybe securing life insurance on a basis which is highly, highly uplifted, so they're paying a fortune in premiums, but then using the exemption under normal expenditure out of income and also getting the life insurance to clear the inheritance tax. You can quickly see how that could be gamed. And this is an area that I would definitely say you're going to have to get advice on if you are considering any kind of strategy so that you don't trigger back-to-back arrangements because HMRC then can put all sorts of punitive taxes if they think you have. So there you go. I hope you found that useful. There are 3 strategies you could use to prepare for inheritance tax, which allow you to control your assets, but also buy you time and make sure your estate passes fully to whoever you want to benefit. So why don't you let me know in the comments, after 2027 and the budget, is this now more attractive to you? Are you interested in pension planning? Well, if you are, I recently did a video on the perfect pension value after the budget and the thinking behind how we work this out. It highlights some of the misconceptions that you may have with pension funding now after the budget, and it's well worth a watch if you haven't seen it already. Either way, thanks so much for watching, and I hope to see you next time.